Hello, and welcome to another edition of Managing Your Money. I'm here with my co-portfolio managers, Matt Bloom, Josh Strauss, and Adam Strauss. And today we're here to talk about interest rates, both our viewpoints on the level of interest rates, future, past, and present, and what implications changes in interest rates might have. So to start us off, I'm gonna cold call someone, just like my business school class, and I'm gonna start with Adam. Maybe Adam, can you give us your thoughts today on where you think interest rates are headed?
I think that, are you asking about long term or short term?
Either, both?
I guess what I would say is ultimately down. Ultimately, I think interest rates are headed down. And the reason that I think that is because the interest rate is becoming increasingly untenable for the US government to pay. We last several years, we've had a persistent 7% federal budget deficit, and that deficit has been driven in large part by a very sharp increase in interest payments as interest rates have risen. And we're sort of hitting the point of compound interest problems where it's getting increasingly difficult to pay. And so how do you figure out a way to make your debts more manageable? Well, at the very least, you start with lower interest rates. So at the short end of the curve, I sort of expect that the Federal Reserve is going to continue to cut despite inflation that's higher than everybody would ideally like. And at the long end of the curve, I'm expecting with time, probably later this year, that quantitative easing will begin again, where the Federal Reserve will once again start printing money to buy treasury bonds to put on its balance sheet to bring interest rates down. So between those two different sets of efforts, that will bring interest rates down and hopefully make it a little bit easier and more palatable for the US government to pay its debt service.
Do you or does anybody think we will see interest rates rise prior to quantitative easing or yield curve control happening?
I do. I do because I think you need I think that the government is going to need a catalyst. Well, government and Federal Reserves is going to need a catalyst in order, because I agree with Adam about the inability of the government to pay a high rate of return on their debt, which is largely short-term nature. So they got to refi that regularly. I think that in order to catalyze quantitative easing, you've got to see rates start to rise where the Federal Reserve needs to come in and say, we're going to do this to cap interest rates for everyone. So, I mean, I don't think they're just going to do it just out of the blue.
You think there'll be
Um,
some pain first, basically?
I would imagine, if it was just Treasury Secretary nominee Scott Bessent making this decision, that would be one thing. But this is Powell, right? Powell is not gonna do that unless he thinks that the Treasury market is getting out of control. That's my view.
So you think Powell is not going to what? It's not going to lower rates or to raise rates?
Well, okay, so on the short end of the curve, he's going to lower rates, right? But he has less control over the long end of the curve because that's been governed by inflation expectations and the credit worthiness of the U.S. government, which owns a printing press, so it's basically credit risk free. But given the fact that Janet Yellen has been very aggressive during the Biden years of just issuing very short-term debt, most of our debt, U.S. debt, is short-term in nature. And so there's not a lot of trading happening on the long end of the curve. So it's easier for the government to manipulate that part of the market compared to the short end. But I just don't believe that you will see the Federal Reserve jumping in and doing what Adam said without some pain first. I don't think Adam is wrong. I'm just saying I think there will be pain first.
Well, I didn't predict straight down. I said ultimately down. I actually kind of agree with you that you need you don't need rates to go up, but it's the natural path of long rates without Federal Reserve intervention is for rates to go up. And I think there's a line in the sand that the Federal Reserve has that they don't want to let interest rates get above. So once interest rates reach that threshold, I don't know if it's 5%. I don't know, I don't know if it's a 10-year at 5% or the 10-year at 5.25% or whatever. I don't think it's very far from where we are right now. But once they cross that line, that's, I think, when the Federal Reserve says, we're going to embark on quantitative easing again to, improve Treasury market functioning. It'll be some, gobbledygook comment like that, where you don't really understand what they're trying to do is cap interest rates at a low level.
I don't disagree, well, I think with both of you guys. And what I think is interesting is how this is going to happen, right? Because you have on one end, Josh already mentioned Powell, and Powell seems to be, it's hard to know what his position is. He certainly started lowering rates in September. Maybe I would think secretly because of what Adam was saying, because the government needs to be kept functioning or financed at a reasonable level. But then again, he doesn't seem as keen as President Trump on lowering rates. And you heard Trump last week basically say, we need lower interest rates. And it'll be interesting to see what conflict emerges this year between Powell, who may not want to lower rates so quickly because he's worried about inflation, worried about his legacy, and Trump, who seems to want a cheaper cost of debt and likely a cheaper dollar. And the key to doing that is lower rates. Do any of you have any thinking on how this interplay between Powell and Trump will play out until the end of Powell's term in, I think, early next year?
I think Powell has shown that he does care about his legacy. He doesn't want to be Arthur Burns, he doesn't want to be the guy who let inflation get out of hand and that sort of thing. I think he cares about that, but at a certain point, I think that the decision is sort of out of his hands, right? Because he has to they have to make sure that the Treasury continues to function. They have to manage that debt load, as Adam described. So I think his hand gets forced. But I think Josh is right that there will be, it won't be a just, okay, we just have to bring rates down sort of thing. It's going to be, something's going to sort of have to break. There's going to be some pain in the Treasury market, and then Powell will sort of reluctantly react. And he'll probably make it clear that he's reluctant too, because again, I think he does care about his legacy. And so he'll want everyone to know that it wasn't really his choice and that he was forced to act. But I think that's how it ultimately plays out.
Okay, so you're looking for kind of some kind of accident in the bond market to force Powell's hand, which could be right. It's interesting to me that in only a week of this new administration or so, it seems a lot longer so far, but Trump has gotten his way on almost everything. It seems like now that probably is unlikely to continue, but his statement to Powell that he wants lower rates was pretty strong, and so I guess the question I have is, do you ultimately think that the bond market needs to break, or do you think that Trump will muscle his way, that he'll muscle Powell into lowering rates because Trump declares that's what he wants? And so far, at least in this initial 7 to 10 days, he's gotten whatever he's wanted.
Well, what leverage does he have with Powell necessarily? I mean, how does he muscle him? Powell doesn't really have anything to lose other than his legacy. So, I'm sure that Trump will use whatever means he has available to him to try to get his way. I mean, that he's shown that that's his MO. But I think there will be a lot of public comment from Trump. He'll try to apply a lot of pressure in the media, but I think that Powell will resist until he doesn't have a lot of choice left.
Okay, and
love him or hate him, Trump sort of has a genius for figuring out what his point of leverage is with whoever he's negotiating with. Last 48 hours we've been reading about like all this stuff going on with Colombia.
Yeah.
And Colombia's number one export to the United States is cut flowers. And Trump is picking this fight with them literally 2 weeks before Valentine's Day. If you had said, what is our leverage over Colombia? I'd be like, I don't know. I'm not sure. So my answer with Paul is, I don't know. I'm not sure what his point of leverage is, but whatever it is, I'm sure he's looking for it.
Yeah, he'll find it. Yeah, that's a good point.
Yeah. No, I mean, it's interesting, which basically means that yes, I mean, I believe, I mean, Trump had a pretty strongly worded statement. He wants lower interest rates. It's clear he wants a lower dollar, and I personally think he'll find a way to get it.
Yeah.
And Powell will hem and haw and probably try to obstruct him. I just don't think he'll be able to stand up to him ultimately. How that happens mechanically, technically, I don't know. But I believe that Trump will find a way to get lower interest rates, which means that Adams' or opening statement I think is probably true. I mean I used to believe in Josh's statement that we need an accident in the bond market to force this change to happen. I'm not so sure anymore if that accident needs to happen or if Trump will just muscle his way into lower rates and a weaker dollar. So with all of that, does that mean it's time to buy bonds?
U.S. bonds?
Yeah.
Doesn't seem like it. I mean, I guess at the long end, if you are convinced that rates are going down, you might get a little bit of a bump as rates come down, and that means that the treasury bond prices are going to rally. But if you're buying that in combination with a dollar depreciation, you're probably better off owning something like gold, which doesn't necessarily have a yield. But if the long end yield goes down, that'll be good for gold, and if the dollar goes down, that'll be good for gold. And so I would, I don't think you'd lose money necessarily owning long-term treasury bonds, but I think that there are better investments to own. And if you look at the 1970s, which was the last sort of period that the United States experienced persistent high inflation, the worst performing asset class was bonds in that decade, and the best performing asset class was gold. So I think we've seen that sort of rhyme the first 3 or 4 years of this decade. Gold has been a better performing asset than bonds and a better performing asset than the S&P 500 index, but bonds have done the worst, and I don't see why that wouldn't continue.
Matt or Josh, do you have a comment on that before I ask another question?
Well, I'll jump in. So, I think the thing about bonds is right now the yield curve is, flattish. Some might say a little inverted, depending on how you look at it, upward sloping, etc. But generally, the short end of the yield curve is, the absolute level is pretty good compared to what we've seen over the last 15 years or so. And that issue, and credit spreads are a little tight. And so you can buy short-term corporate bonds or short-term treasuries, depending on what credit you're getting, between, 4.25% to 5.5%, right? If you're buying treasuries, you've got ultimate liquidity and you can sell it and go buy something else if there's an opportunity. With corporates, there's less liquidity, but unless there's a big blowout on credit spreads, you're going to be just fine. And in 1 to 3 years, you're going to have your bonds available, not available, but they'll mature and the cash available to deploy it as you see appropriate. So, if you're a retiree and or an institutional buyer where you have to have a certain percentage of your assets in fixed income, it's not so bad. But, would I rather own gold than a bond? Yes. Would I rather own certain inexpensive stocks that have lots of upside to them than bonds? Yes. But if, you have to look at the individual or the entity's particular situation to see to what extent a bond actually does make sense.
So I'm hearing from both of you as you talk about other alternatives, whether it be gold or other securities, that maybe what's going on in bonds makes you question overall portfolio asset allocation. Is that right? And if so, how would a modern portfolio manager today change the allocation thinking what you do about bonds and interest rates?
Well, I mean, I would say, so let's say let's choose a younger client with a long time horizon and an older client and talk about the difference. Okay. I believe that the investment outlook for physical precious metals, gold, silver, uranium is very attractive. And I put that in the category of other or alternative investment. I would say a young client should have, let's say roughly 20% of their investable assets in those categories. They're going to act differently than stocks. They're going to have protection if something bad happens. You're going to have protection if inflation happens, which is something bad too. But gold and silver are great assets to own in the case of inflationary environment or in the case of financial dislocation. Then for an older client, let's say a retiree, same thing. I think you should have 20% in fixed income. Or not fixed income, sorry, in alternative assets. While the younger client, I don't think you really need much exposure at all to bonds. The older client, maybe you have 30%, 25, 30% in the short-term bonds that I described, with 50% in stocks. It's just, the inflationary pressure is high, and you don't want to get smoked if you're living on a fixed income.
Yeah, I think it's a real return question, right? Because I mean that's really the risk with having a significant bond allocation now is that if Adam's right and we let inflation run hot and yields are below the level of inflation, I mean you're just going to see your purchasing power whittled away over time. Going back to this Adam's mention of the 70s. It was a terrible thing to own bonds, especially when you look at the real return. So I think bonds still, they have a place in a portfolio, especially with that older client, but more so just to tamp down maybe volatility than to really generate returns, because your real return on bonds over the next 10 years is, in my opinion, unlikely to be attractive.
I think it's Luke Roman who said in an inflationary environment or in a wartime environment, the first casualty is the truth and the second casualty is the bondholder. And I would agree. I mean, what you're basically saying is that, we are certainly in seemingly an inflationary cycle. We've certainly been in some type of Cold War or hot wars and in cold places. And as we see in the Middle East and Ukraine, when that happens, inflation goes up and bondholders get hurt on a real basis. So what I hear from all of you is that it's a time to think about asset allocation a little bit differently. And I would agree. And maybe I'll share some charts here because I always think a picture is worth 1,000 words. But I would argue that the huge bond bull market that we have witnessed from roughly 1980 to let's say 2020, that 40-year period is over. As bonds, made, I don't know, 3,000-year lows in 2020 across the Western world. And now we are likely to see a period of a sustained bond bear market where interest rates are higher or they're higher until they get capped. But we certainly are not going to see the last 40 years of just increasingly lower or ever lower interest rates that push bond prices higher. And I think that investors, portfolio managers, make the mistake of fighting the last war. And so just because most investors today can't remember a period, or few can remember a period of what it was like to be in a bond bear market, I think people can't really comprehend that it's possible to be in a period where bonds don't provide excellent returns. And we're in that period now. So let me share my screen to illustrate this.
Yes.
Okay.
Yes.
Okay, so this chart's a little bit dated, but directionally it's correct, and this shows TLT is basically the 20-year. It's an ETF that holds 20-year bonds, so it's basically a kind of a good proxy of the return of long-term Treasury bonds, and it's an asset that is held by a lot of investors. And you could see this is basically a 10-year or so, or 11 or 12-year chart, and you could see price is in red of TLT and fund flows is in white. And what's kind of fascinating is, and few people really understand this, that you've seen, the long-term bonds, at least until kind of early 24, it's a little bit dated, have a negative return of 48% over this 10-year period. It's been actually a horrible period for long-term bonds. And despite the fact that returns have been so bad, assets counterintuitively have kept rushing into bonds. And I think this is because people's muscle memory, people can't quite they can't quite comprehend the fact that bonds are a place that you can lose money, one, and that it won't protect you against inflation, because we've had none of that go on for almost the last 40 years. And so investors looking backwards are pouring into a long-term bond fund just at the time where it's I think very, 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 very dangerous to do so. That's one. Let me shift this over here. I think
Quick question here,
yes.
Billy. So TLT is an ETF, and they pay out income monthly, right? So
It's probably right, but I don't know for sure. Go ahead.
I think it's monthly, and you're going from 2012, 2013 till 2024, I guess. And I guess I'm trying to understand, with the ETF, it's full total return matters. I mean, it's still bad. I mean, I'm looking at total return of it. It was down 8% in 24, up 3 in 23, down 31% in 22, down 4.6% in 21. So, I guess my only point is I think that disparity is not quite as wide as you're showing, because there is the income part of the return that's missing here.
Oh, it's possible. It's possible. And you could be right. You could be right about this. This may not include. This may not be total return here.
It's still enormous, though. I mean, the return of bonds in the last. I think the important point is the returns of these long-term treasury bonds over the last 5 years have been like the worst in history ever.
Yep.
And at the same time, assets are going straight up. So we can argue about whether it's negative 48% or negative 38% or whatever, but the point stands. It's been a horrible time to be a bond investor.
Right. Agreed. Which is that's actually my whole point, which is it's rare for investors to pour money into an ETF that has returned so poorly, whether it's negative 48 or 32 or what have you. And that's exactly what's going on. And I would argue because people's muscle memory, they can't imagine a world that you guys are talking about. They can't imagine a world where bonds aren't fulfilling their job in the portfolio of providing positive real returns. And I would argue that era is over now. They're not going to provide positive real returns. You have to keep your duration to bonds lower and keep your allocations to bonds lower. There are other elements of the portfolio that I think will provide protection. I don't think that what Adam was saying, that bonds are the anti-fragile asset anymore. They used to be. Anti-fragile means an asset that protects you in a portfolio. And I don't believe that that's what bonds did. They played that critical role from 1980 to 2020. And I think they've stopped playing this role, as you can see in this chart. And yet investors haven't quite understood that as the money chases into long-term bonds. This is a wonderful chart here. Can you see this chart? Exhibit 66, U.S. 15-year Treasuries, 10-year rolling returns.
Yeah, probably should. Okay. You should make it larger, though.
I'll make it bigger for. Here is, if this is easier for people, and this is kind of fascinating to me. This goes back 100 years, right? And basically, this is the worst long-run return for U.S. Treasuries in the past 90 years. So basically, the last 10-year return, similar to what you saw in that last chart, is negative. Which is, and this is that the TLT charts for 20-year Treasuries. I think that this is 15-year Treasuries, so the return numbers are different. But we've never really had a period going back to 1980, right? We've never seen a period where the past 10-year return's been negative. In fact, it's been quite positive. You go starting from 1980 all the way up until, I'm not sure where this is here, 2020-ish, I guess, but if you look at these past return figures, you're seeing bonds delivering returns or rolling 10-year returns of anywhere from 4% to 8%. And so bonds, right, historically, were doing their job, right, in providing balance in the portfolio and at least a positive return. And in a low inflationary environment that we had certainly in the last 20 years, maybe not last 40 years, they certainly provided outsized real returns. And now you have, the worst 10-year period in 90 years. Now, the question
This is an amazing
is
chart, Billy.
it's an amazing chart, and I have two more amazing charts that I'll show you where I started, and well, I'll start here. The amazing chart, and this is what Adam started off with, which is this is the chart of U.S. public debt outstanding, and going back to well, 124 years, roughly 123 years, whatever, and it's just a stunning figure that by the end of 2024 we have $36 trillion of U.S. government debt, and it is increasing, per the chart says, at $1 trillion every 100 days. So that means in a year's time, roughly, our debt should increase by about $3 trillion. And it is just stunning. And Adam was talking about having to keep the government's debt affordable. We've never been in a situation where, in peacetime at least, or at least in I said it was wartime, it is the semi-wartime, but at least we are not involved in a major confrontation or a hot confrontation like we were either in Vietnam or World War II or World War I, where we saw our government debt explode because we were fighting a major war. Here there are proxy wars going on that we are subsidizing, but as we all know, thankfully, we are not engaged in a major conflict, and yet we're running budget deficits of 7 to 9% of GDP that seem like we are in a major conflict. So, and either that or we're not in a major recession, which is all the other time we see our deficits enlarge. And yet here we are running increasing debt by $1 trillion every 100 days. This goes to someone's comment, I think it was Josh's, that says, hey, it's logical for the direction of interest rates to go higher. And I would say that this is logical. And, this would bring you to this chart here, which is basically going all the way back to 1790. This is very long, but we saw the first great bond bear market from 1899 to 1920. We saw the second great bond bear market 1946 to 1981, and that was the end of World War II. This major conflict that we fought that drastically increased our budget deficits and our debt. And from 1981 or 1980 or so up until 2020, we had this major bull market in bonds that everybody thinks is still around. And now I would argue we are at the onset of this third great bond bear market, where interest rates should go higher.
But just going back to the first question that you asked, actually, I think what we're all saying, if I'm understanding everyone correctly, is that we're near the end of the third great bond bear market, because pretty soon the Federal Reserve is going to bring those interest rates back down again, which doesn't mean it's a great asset class to own, but I think this great bond bear market probably isn't going to last too much longer.
And then it's just going to become a grinding slog.
Right.
Right. Where you just basically you just get, it's death by 1,000 cuts. You every year you lose purchasing power,
right,
rather than getting hammered as bond investors have over the last 4 or 5 years.
Right.
Yeah. The question is, I was going to say the question is, what does that chart look like if you were to look at real returns?
Yeah, that would be
and going forward.
Yeah.
Right. Because if you're only getting paid, if what Adam says transpires and you see quantitative easing happening by buying long debt end of the curve and capping interest rates at 5% and inflation is high, it is, to use Matt's point, it's going to be a grind.
Right.
Right. People are going to have a hard time.
I was just thinking that if we're sort of following the path of the 1970s, but with somewhat of a difference in the sense that in the 1970s there was no capping of bond yields; they just let the bond market go. And in this case, we will be capping bond yields. So if there's a similar sort of total return trajectory, I think what that means is that by not allowing bond yields to go where you need to go, if you're going to have the same sort of negative return owning bonds as the 70s, it means the currency has to go down a lot. And so that, I mean, that's one of the things that I sort of got from that chart is, wow, if we cap bond rates and we're in that same path of the 70s, currency has a long way to go down.
Yeah. Yeah. I have a couple of takeaways. The first is, as Matt was saying, you're right. I mean, I think if interest rates were allowed to, if the market were allowed to determine interest rates, then I think you would see interest rates go up over time, just given our dire fiscal situation, and we would be in the holds of a third-rate bond bear market. But I agree with you that they won't let that happen, that they'll cap interest rates because our debts are too big. They can't let what happened in the 1970s happen here. Then debt to GDP was 30%. Now it's, over 100%, maybe it's 120, 125%, depending on how you count it. And so they'll likely cap interest rates and go to what you said, Adam, into some form of yield curve control. But that means on a real return, we will be in a bond bear market because inflation, if they're not going to raise interest rates, inflation is going to be higher. They'll cap those rates at a lower level, and on an inflation adjusted basis, it will be a bond bear market. You just won't see you won't see rates rise commensurately.
That's right.
I think also your part about devaluing the dollar is true. We've seen that happen. That will happen under this inflationary environment. What's interesting is that there is a saying that inflationary environments create monetary illusions. And what that somewhat means is if you were to, obviously the S&P 500 just as a proxy has gone up a lot. I've seen this data. I'm just going to go back to 2018. If you look at the S&P 500 pre-COVID, 2018 until today, the last 4 to 6 years, it's gone up a lot in dollar terms. But if you were to express the S&P's return in gold terms, it's gone nowhere. Meaning that
Since what date?
it's
Since what date?
2018 or so. So meaning that it's a monetary illusion. Yes, the numbers have gone up, but the currency has gone down. It's really just that the dollar has fallen in value. So you feel wealthier in a way. Your statements are fuller, but on a purchasing power basis, we all know that inflation has gone up a lot. And so against a constant store of value that rises with inflation, namely gold, the S&P 500 really hasn't moved anywhere in 6 years.
Well, and if you go back to 2000, it's in a significant bear market.
Since gold, yes. Yes. Now, there are other points in time where it's been in a bull market, certainly since 2010 or 11 or 12, it's been a bull market, but yes. But I'm just looking at the last 5 or 6 years, and it's shocking to actually think that. So, I mean, it goes to your point, Adam, what's really going on is the dollar is being devalued. That's really what's going on.
Yep.
And that's bad for long-term bondholders that are subject to a fixed return with an ever weaker dollar. Anybody else have any other comments they want to add?
I'm going to add. I want to get Matt to add a comment. Matt and I were chatting earlier today, and Matt came across an interesting tidbit of information in the backwards world of closed-end fixed income funds. And Matt, why don't you tell the guys a little bit about what you came across and what you think that may or may not mean?
Sure.
That signal?
Yeah, well, actually, Bill heard me mention this last week as well. But one of the things we look at in closed-end funds is we look at the premiums and discounts, right? Because in closed-end funds, they're a goofy vehicle, but the price that these things trade at in the open market can and often does deviate pretty substantially from the value of the underlying assets that are held within the fund. And so you can see these really big premiums and discounts between the price and the NAV of the funds. And we track those discounts and premiums. And just last week, I was looking at the sort of like top 100 of all the closed-end funds out there in the fixed income space. I was looking at the top 100 largest discounts. And of the top 100 largest discounts, 75 of those funds are munis. And that's way higher as a percentage than at any point that I mean, we've been tracking this for years, and it's a much higher percentage than it's ever been. Usually it's much more balanced, right? Either there might be one particular area of that market that, has a few more, or a few, or fewer. But seeing 75% of those 100 largest discounts being one particular type of fund, I thought it was interesting. And I thought, well, there has to be something meaningful here. I just don't know exactly what it is. But so we started tossing around ideas when we were discussing this, what might it mean? I mean, one of the things that we talked about was that there might just be a mismatch between liquidity, right? Because the muni market tends to be so much more illiquid than, say, like the treasury market, right? Which is the deepest most liquid market in the world. And that maybe just because munis are so illiquid, that the NAVs have a significant lag behind the actual prices at which these funds trade. But I don't know. We're just trying to we're throwing out ideas, but we're trying to determine if there's any kind of actionable information that's being transmitted by that data point. And so just put it out there for you guys and see if there's anything, see if you have any ideas for what that means, to see that munis are so they appear to be very, very hated right now, at least in the closed-end fund space.
When did they enter this territory? When did it start happening that muni bond discounts became so large?
So the last time we ran this was about a quarter ago. It was in October, so it was pre-election. It was shortly before the election. So this is the first time that we've looked at this data since the election. So there's it's very possible that this is something related to, something investors are thinking, related to the Trump administration.
I mean, one theory that just crossed my mind as you were telling me is that it could be the Trump effect, in that, I mean, I think there's been a significant amount of federal dollars that have gone into various cities that have helped shore up their own budget deficits.
Mm-hmm.
And it could be a view among investors that the Trump administration is going to leave a lot of these cities and states to fend for themselves, which could make them a higher credit risk than they otherwise would be.
Well, and interestingly, a lot of these closed-end funds tend to be focused on cities and states that are not so much Trump strongholds. The really high tax cities and states tend to lean blue, and that's where you see the majority of these muni funds operating.
Well, that's also where the majority of the municipal debt is too.
Correct. Yes, that's true.
Yeah.
Well, but
it's also
for higher tax rates.
We're also talking about junk munis, not more so than investment grade too, correct?
Yeah, I would have to go look and see what the breakdown is between investment grade versus junk, but my instinct is to say that it's majority high yield stuff.
Right. Okay.
Yeah. Anyway, just kind of an interesting thing to notice.
Yeah, I will. That's interesting, Matt. Thank you. I would say that most bull markets tend to happen in asset classes that are hated and underowned. And, we have the opposite today in bonds. As I showed you that first chart, it is very much owned and not hated enough yet, despite the fact that its returns have been so horrible, which sets us up for a period of likely underperformance. But, ultimately there will be a bull market again in bonds. It's just not going to happen now. Perhaps it's 10 years from now. But I think that our take so far, our cautious stance on bonds is correct, that we are in the midst of a global sovereign debt bubble, government bond bubble that is being unwound, and that is going to be painful. That is not near-term bullish, it's near-term bearish, and which might require a meltdown in the bond market, as Josh surmised. It might require some type of yield curve control, as Adam talked about, some types of dislocations in different fixed income markets, as Matt talked about. let me just read you a couple stats as to how we got here, which I think is fascinating to me. We've been in an era where governments continue to issue more debt. They're running larger deficits, and larger deficits means more debt. Global government debt has risen 40% in the past 4 years to almost US $100 trillion. The US is basically 1/3 of that total. Japan is 15% of that total. And what's interesting is that governments are no longer running surpluses. They're running large deficits. As we just talked about, the last time that China had a budget surplus was 2007. The last time the US had a surplus was 2001. The last time Japan had a surplus was 1992, and France was 1974. So all this to say is that we are in a period of big government and big spending, and that is usually negative for bonds.
Wait a second. The era of big government, I guess I'm just trying to understand that statement because, that would be the opposite of what Trump claims he's trying to do. I mean, is it just more of like he has no control over the big government or very little, and it doesn't really matter?
Well, Trump is a reaction.
Well,
he's a reaction to big government, right? I mean, that's right. We have big government. We've had big, if government debt has expanded tremendously over the last 4 years on a global basis, right? You get politicians or sometimes you get politicians like Milei in Argentina that come in and try to stop this because you're kind of at a crisis level. I would say that the U.S., if it weren't for having the reserve currency, would be at a crisis level. But part of Trump's agenda, right, is to kind of curb the U.S. government and big government in the U.S. Whether he'll succeed with that is questionable. But so I mean, your point, Josh, is that Trump is going to. What's your question? That Trump is going to curb big government?
No, I don't. I think he would like to. I don't think he will. I just was trying to understand your statement, but given what Trump is trying to do, it just, I mean, look, the whole world is moving to the right as a broad stereotype characterization, whatever you want to call it. I mean, you're seeing it in the UK, you're seeing it in France, you're seeing it in Italy, you're seeing it in the United States, you're seeing it in Canada, and so then but the problem is that the era of big government, I don't think that it's over. I think that these right-leaning politicians don't have the ability to make the adjustments that they would like to do. If you're a right-leaning politician in Canada, you're not going to get rid of socialized healthcare. You won't touch it, right? So there's a lot of that sort of thing. So I was just more so trying to understand where you're leading with a big government comment.
Well, I was just saying that we've got to the buying crisis that we're in because big governments all over the world, right, have been gorging on debt, right, and it's this huge overflow of debt that has created this bond market that's unsustainable and unfriendly, right? There's too much supply, there's too much debt out there, and that's why returns are not going to be good. And I think the risk we have now is that there's just too much debt everywhere, which is why I think we're going to be in an era of a bear market in bonds. Now, what the political reaction to all this, Josh, you're right, is it's unclear still. And I think part of the right-wing shift today, at least, for many governments in the Western world, is a response to the problems with major government spending or unchecked government spending in the West, at least, partly. Now, whether they can solve these issues or not, I'm not sure. I'm doubtful that they can solve it because I think the debt is so huge today. I think the only way to go forward is really where Adam started, which is to inflate our way out of this, to devalue currencies, to cap interest rates, and inflate our way out of this debt, which is why bonds in an inflationary environment are not going to be good after inflation vehicles for portfolios. So keep your allocations checked, keep your duration short is my parting words.
And credit quality?
You don't get paid to take much credit risk, so
No, you don't. No, you
There we go.
don't.
I
Yeah.
mean,
Right?
yeah, now is
It's
not a time to be owning a bunch of junk bonds.
no,
Yeah, agreed.
Historically low spreads. Don't bother.
All
just
right.
not getting paid.
I would agree with that. Any last comments before we wrap it up? Okay, thank you all for participating today. I hope you enjoyed this edition of Managing Your Money, and thank you until next time.